Hi, Bill Lewis here, and today we're talking to Tim Tolbert with Home First Lending, and we're going to be talking about myth versus reality as far as if there are any new requirements for FHA, Freddie, and Fannie. Hey, Tim, how are you?
I'm doing great. How are you?
Great. So, people are under the impression that there's new FHA, Fannie, and Freddie requirements for home mortgages. Is this true?
It depends on who you are. If you're a company that's bound by your warehouse lines and items like that, then yes, but it's not Fannie and Freddie or FHA that's changed the guidelines. It's the investors who are funding their warehouse lines. It is. So, and by warehouse lines, think of it as a giant credit card that they, put the mortgages on until they get sold off to the investor. So if they control your credit card, basically they control your business. So you're seeing a lot of people who are out there saying, well, they've changed Fannie Mae to 680 credit score. They've changed FHA to 640 credit score requirement. And they mean them or their investors. They're not, FHA hasn't changed, conventional hasn't changed. If anything, they've actually changed for the better. They've made concessions for our current situation regarding employment verification, what they'll accept as far as employment verification. Now, one thing we are seeing, which you want to make sure with any of your buyers out there, if they're looking to close on a loan, make sure they get contact information for their direct supervisor, because a lot of companies have migrated to the work number, and their verification system is a couple weeks out sometimes. And investors are requiring anywhere from, used to be 10 days before close in a normal market. Now they're looking at 5, 3, or some are even doing the day of close, getting verification of employment the day of close prior to authorizing funding to make sure the person is still employed. Because by federal law, they have to, they can't write a loan to someone who doesn't have the ability to repay. That's one of the things in the last revisions back in the 2008 range, where they wrote into law where you must prove ability to repay to do a loan. Okay. So if they're not employed, they can't get a loan. Right. But as far as FHA is concerned, we still have the ability to do manual underwrites. Still can do the 580 credit score, that's still there. So all of it's, but we're now more limited on the investors we can take that to, but we do still have options because, like I said, FHA didn't change their guidelines. It's the investors themselves that have changed accordingly. Like, for example, for a while we were doing bank statements as full doc loans, the other kind of what they call non-QM loans, which means everything other than Fannie, Freddie, FHA, VA. That's like what we used to call back in the day our subprime parameters or Alt-A parameters or whatever. Okay. But those investors had pulled back and basically stopped that for the most part. Or those that are doing it at a much higher cost and a much lower loan to value, because the whole slowdown with the economy affects small businesses more. So and those products are primarily designed towards small business owners who don't show income in the conventional way. They shelter a lot of their income. They write a lot off. So they don't show, the normal tax return income that would support. So they have to go alternate means. Well, if they're the ones that are at risk with the economy drop, the lenders don't want to write those loans because they don't want to put them in a bad position. So it hasn't disappeared. Basically, they just took time off for a few months and said, hey, when all this dust is settled, we'll come back into the market. So the products are still out there. The investors are still there. They're just not funding anything right now until this dust settles.
Another takeaway to this is not all mortgage brokers are the same.
Correct.
So if you get turned down by one, doesn't mean that you're turned down by all of them.
Yeah, I've taken, in the last week, I've got, I think it's 3 or 4. Well, actually, I know it's 3 that are currently in underwriting that were turned down by another company because of their internal changes. And they had to change it. What nice part is the file's already done. We've got it in underwriting now. We don't have to wait on appraisal or anything like that. So it should be a pretty quick turnaround for them, fortunately. But, it's not like an overnight thing because we still have to meet all the federal requirements. But, hopefully if that does happen, they will give you far enough notice so you can, we don't have to upset any transactions. But we are seeing some complications in the industry that's not just lender specific. It's because of the intense volume that they're getting and the constant changes. And now everybody is kind of working from home.
Hmm.
It's causing some time frame delays with the lenders and their underwriting. So just expect the unexpected, because that's the market we're in. But I would say, like we said before, if you can buy, now's a great time, because there's a lot of people who are sitting on the fence because they're either been furloughed or currently unemployed because their employment shut down for a few months. But as
Right.
soon as they go back online, to come off furlough and back to employment, I would expect the market to take off, and then you'll have more competition in the market right now. I mean,
Okay.
we probably got 20% less because it's a 20% roughly unemployed right now.
Right. So the takeaway from this is not all mortgage brokers are the same. If one turns you down, might be worth it to look at another one.
Yep, and
So
not all mortgage brokers do the same products.
that's right. That's exactly right. That's a topic for another session.
Yep.
Awesome. Well, Tim, we appreciate it. You have a great day.
All right. You
Bye.
too. Have a good day.